Holy smokes, it's Black Friday, and yeah, this is the biggest sale I've ever done on the courses. Link down below. And in this, you're about to see why. Let's get into it. Okay, you don't want to know what Societe Generale is warning of here, but I'm going to tell you anyway. It's not good. So think back for a moment to the Great Depression. You might not remember it. It was like 90 years ago. Unemployment rose to 24.9% during the Great Depression. It didn't go to 24.9% because of inflation. It went to 24.9% because of deflation. Yes, deflation led to nearly a quarter of the active workforce wanting a job not being able to find a job. Deflation is really bad. There's a reason why Milton Friedman tells us that inflation is an entirely monetary instrument. It's because when the Federal Reserve does not turn the money printer on to prevent deflation, capitalism drives deflation. Everybody wants to offer lower prices so that they can get sales before a depression. Of course, that's when the Federal Reserve usually takes out the money printer and says, nope, we're not going to let that happen. But what happens when they don't? Well, what happens when they don't is what happened during the Great Depression. 3 years in a row of prices falling 7% per year. Actually, it was about 4 years in a row. 1930, 1931, 1932, 1933. That on paper looks like 3 years, but it's actually 4 years. 4 years in a row of deflation and the Fed not responding. What did that lead to? 25%, well, 24.9% unemployment. A ridiculously high number. And it was as a result of our money supply turning negative, which that's already what we're seeing happen in America today. Year over year, the change in the money supply contracting at the greatest pace we've seen, well, frankly, since the Great Depression. Now, this is, of course, a year-over-year change number. The money supply exploded last year. So when you normalize this figure and just look at it from a billions of dollar point of view, our money supply is obviously substantially higher than where it was at $15.4 trillion during the leading into the pandemic. Now we're sitting at 20.7%. But the question is, how, are we basically mad to be talking about a deflationary depression now? Well, let's just see what companies are saying about it. So here's Walmart. Okay, Walmart says, well, Michael, it's good to speak with you. One of the things we're going to look closely at in our business is units. Like, how many units are we selling? Volumes of numbers, right? And we've seen good growth in units. So we're not just entirely driving our revenues by higher prices. Things are still good right now. We're still coming out of an inflationary cycle, right? We think we're positioned well. We go into the end of this year and into 2024. To answer your question, though, about pricing, it depends on what's driving the 2% comp. Okay, so what's driving the 2% growth that Walmart sees going forward? Well, here you go. Listen to this. So if it's hard to extrapolate trends from this year into that, the team here is being very focused on what could happen, quote, in a more deflationary environment, and making sure we have a cost structure that supports revenue in whatever environment we're operating in. This, folks, is the earnings call that was published on November 16th from Walmart. And what they're doing, and I wrote it here because we covered this in our course member live stream, is holy smokes, this is the Fed getting ready for deflation. That's what I wrote right here. Cost cutting can lead to unemployment. As you cut costs and prices come down, you try to be more efficient with the employees you have. This is what we saw during the Depression. This is when the Fed needs to print. It's when they refuse to that you end up in a depression. We're really pleased that our U.S. businesses are seeing rollback counts up significantly, that this Thanksgiving will be one in which Walmart will have lower prices than a year ago. Okay. is Walmart, okay? Maybe Walmart's trash, okay? Okay, what about Levi's? This is Levi's. It's Chip Berg. We're very disciplined in trying to really understand what were the most price-sensitive items and adjusting the price in those items and those items only, except not up, down. Levi's talking about prices going down. Vans, the shoe company, talking about prices going down. What about Costco? Oh dear. The vice president and CFO of Costco, well, answering a question here about 1 to 2%, of potential price growth, being responded to like this. Well, first of all, your comment that was on the 1 to 2%. We're talking about the 17 weeks or about 4 months roughly. And we're looking at these 4 months. And, basically, what we're noticing is a downward trend, if you will, a little. And when I talk to merchants on the fresh side, the food side, it's flat to down a little bit right now on the food side. In other words, with the exception of sun-dried things like raisins, okay, very niche things. But basically, things are trending to 1 to 2%. If anything, they're trending to negative, okay? And then we see the consumer packaged goods side and non-food being down year over year in a nice way as freight costs are down after freight went through a recession, basically. And in some cases now, commodity costs are just straight negative. So that being said, we're not seeing a big change, but at least we're trending that way. Who knows what tomorrow brings? And it is related to, multiple things, I would say, but it relates to pushing prices as fast as we can. We want to be the first to lower them when those things happen and drive sales. Holy smokes. Wait a minute. Costco saying we want to be the first to cut prices. Walmart saying we're cutting prices. Levi's, Vans cutting prices to be lower than what we're seeing last year. Not only that, but now we literally, and I want to show you what Societe Generale is saying because I think it's a very big deal. But not only that, this guy Meet Kevin is saying welcome to Black Friday. He's talking about deflation in his Black Friday sale, 77% off the bundles, the lowest prices for the next year guaranteed, 75% off any of the programs, and the release of all the new Verse Pro courses coming this Monday, which if you check out on any of these courses, you could bundle up to brand new 2023 content. This is deflation in earnest. Okay, yeah, I did just sneak into, I snuck in a Black Friday sale into the deflation talk, but that's what's happening. Let's just be real. You have to be competitive in this environment. Prices are going down. Prices are going to continue to go down over the next year. Now, that doesn't mean we're back to levels that we saw in 2019, but companies are starting to cut prices. A lot of companies are starting to, quite frankly, panic. I think Costco, which makes like 50% of their net income from, guess what? Memberships. Okay, they just want you to be a member. So they want to come across as having the best prices. And if they don't have the best prices, then what happens? You end up with a deflationary bust. So yes, in talking about a deflationary bust, I did just build in a Black Friday coupon. So go to meetkevin.com to see the lowest prices. We are not only reducing prices via deflation, but we are also offering a price guarantee that Black Friday today will be a low. So we're trying to shoot in such a way that we're shooting it straight with you. Other companies are lowering prices. We are going to make sure we have the best prices for Black Friday now for the next year. So if you want to check out the courses and get lifetime access to the courses, the course member live streams, you want to be part of the brand new 2023 lectures that are coming out on Monday. They're all dropping on Monday. Those are in the new Verse Pro courses. You want to be a part of these, or you're an existing member, go to meetkevin.com, check it out. Email us at staff@meetkevin.com if you're not already a member. So what do you have here? Societe Generale tells us the following. The Federal Reserve in the 1930s made a massive mistake. It allowed the money supply to contract without printing money. We already see that the money supply is negative now. The Federal Reserve needs to strike a very delicate balance that we don't end up leading to another deflationary bust due to Federal Reserve over-tightening. And folks, that's exactly what we could end up facing. Now, the Federal Reserve is going to keep a very tough face-up of, oh yeah, we're not going to cut until deflation or inflation drops back to 2%. Fear not. But what about when that housing inflation that we've just started seeing roll over comes at the same time as a rollover in goods, and potentially we start seeing that unemployment levels start slowly tick up? The Federal Reserve really has no choice but to cut. The question then is, how much does the Federal Reserve cut? If we look at the world interest rate probability, what do we end up getting? We end up getting cuts of between now and January 2025 of only about 1%. That would be roughly 4 rate cuts of 25% or 25 basis points each. Now, this number is heavily debated. A lot of folks say, no, we're not going to see 4 interest rate cuts. The Federal Reserve's not going to be that aggressive. They're going to stay higher for longer. And that, frankly, is what the bond market is pricing in. Although the 5-year break-even level is finally starting to fall. We're seeing the 5-year break-even level come down. We're sitting at about 2.23 on the 5-year break-even right now. And when we jump into the 10-year Treasury, we find the Treasury yields are actually up at the time of this recording, 4.486%, up 7 basis points today. The Nasdaq's negative in pre-market, Dow and S&P slightly positive. I'll hide myself from this for a moment. But the big warning that Societe Generale gives us is that, and it's not Generale, I know that's like the American way to say it, it's Societe Generale. That's if you want to say it all French. But anyway, it's so important to consider the 1930s Great Depression, that price cutting leads to job cuts. And once that cycle starts, the deflationary bust starts. It can be very difficult for the Federal Reserve to stop it. So maybe we should be more concerned about paying attention to deflation and prices falling than we should be concerned about prices rising. That's my take. Let me know what you think in the comments down below. It might seem crazy to worry about deflation at a time where prices are still up from before COVID. And you know what? It might be a welcomed relief to see prices fall. As I said, today's Black Friday. You get the best prices possible. We're super excited to lower the prices and bring you more value at the same time. If you're an existing member and have questions, email us at staff@meetkevin.com to make sure you can get the best access to the lectures that are dropping on Monday in the New Verse Pro courses, or the other lectures that are dropping in the other courses totally for free for existing members. My goal is always to bring more value, so send us an email, staff@meetkevin.com. If you're a new...
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
member considering becoming a course member, email us at staff@meetkevin.com as well. Thank you. Bye.